I want to start by talking about where you live. As I predicted very early in the pandemic, literally mid-February of the start of COVID, I predicted that there would be this mass migration away from cities to suburbia and also to rural areas, but not to as much of an extent. But let's talk about that. I noticed that when I left California just over 10 years ago, my wealth started to grow a lot faster because I wasn't spending so much on housing, and I certainly wasn't spending so much on taxes and all of the other very high expenses that go with living in a high-priced state, a left-leaning state. But this map shows you the different tax rates in each state. California is number 49. It is one of the worst states to live in as far as taxation. New York is number 50, and you can see around the country all of these different ones. But guess what's number one? Florida. Number 7 is Texas. Texas used to be really, really super desirable. It still is very desirable, relatively speaking. But Florida ranks numero uno. Okay, numero uno is Florida now. It's just really amazing when you stop paying the government so much darn money, how much more quickly your wealth can grow without the taxation. And remember, we love the most historically proven asset class in the entire world, income property, and we love the most tax favored asset class in America, income property. So there's a lot of great strategies. If you do live in these expensive states, check out our prior episodes, join our Empowered Investor Pro group to really learn more about how you can optimize your tax strategy and save on life's single largest expense, taxation. That's the single largest expense for most people. All right, the Wall Street Journal, the doomsayers talking about how the market is crashing. Just not happening, folks, at least not yet. There will be more changes some days, but the latest news from the crash bros, if you will, is that new home building is going to crash, and there's an oversupply of new homes, and that new home builder stocks are going to be way, way down, and the complete opposite has happened. Look at this. This is the Wall Street Journal today. New home builders are doing great, right? In terms of the residential market, stock index up 17% so far this year, the complete opposite of what all the doomsayers said would happen with the new home builders. And the resale market extremely strong in most good areas because there's just such a complete shortage of supply. Just over 400,000 homes for sale in the country. That's literally about half of what it was in 2019 pre-COVID. It's about 1/3 of what it needs to be considered a normal market. That's just normal, not a bad market. That's just a normal market. We have 1/3 of the inventory we need to have a normal supply-demand ratio in the marketplace. But office space, the complete opposite. It's really, really startling what's going on. Around 30% of the office space in downtown Los Angeles was available for lease at the end of last year. That is the highest figure in any major U.S. office market. It's bad news for Los Angeles owner-operator Brookfield Asset Management. Just talks about how that company's shares are down more than 80%. So again, as I said, dating back to 2004, invest in housing. Housing is the thing they can't outsource. They can't open a call center in India or the Philippines, right? Lessening the need for office space. They can't outsource the manufacturing to China or Sri Lanka, any of these big manufacturing countries, because everybody in the US still needs a place to live, right? And that's why housing is the most important thing. And here you see that 9.6% is the number for seasonally adjusted increase in single family home sales in March from the prior month, according to the Commerce Department. Now, just before we get to the episode today, which is going to be an interview I did recently where I'm being interviewed, and I think you'll like this, I just wanted to show you these two proformas. Now, if you've been to jasonhartman.com, and you probably have, and you've looked at our property proformas, I wanted to bring you this one first, and this came up on my Facebook memories. Such a good way to keep you honest, right? Facebook memories. This was March 4th of 2014. 2014, almost 10 years ago. And we see here that I was talking about a property in Georgia that was $86,000. I know, amazing. Only $86,000, fully rehabbed, fully remodeled, rent-ready property. And this property had a projected total return on investment of 50% annually. Well, guess what? It did better than this. This property performed better than expected, or I should say, all of these properties in that general area, because none of us had any idea that the market would just become so good, and that all of these people that got those higher rate mortgages 9 years ago, just over 9 years ago, would be able to refinance those mortgages and renegotiate the deal many times over, especially refinancing them in the lowest rates of the COVID era. So unbelievable, right? Now, here's a property from today. This is a brand new one we just got. Now, this one, of course, it's much more expensive. This is in Florida. This is Citrus Springs, Florida. This is a brand new property, new construction. But guess what? We have a Zoom meeting coming up on this. We have a special deal where you can get 4.75% mortgages. Yes, I know. Doesn't that sound unbelievable? We've got some really special financing opportunities, whether it be our 100% financing or our 10-year interest-only financing or 4.75%, 30 years fixed. Unbelievable, right? That you can pull that off in this market. We've worked out a special deal for you, so check that out. Now, this property in Florida has a projected return on investment before tax savings of 25% annually. As I always say, even if it goes only half as well as expected, that's 12.5% annually, 12.5% annually, if it goes half as well as projected. What else are you going to do? What else are you going to do with your money? You think you're going to outperform that in stocks, precious metals, cryptocurrency? What is going to beat income property, the most historically proven asset class in the entire world? Even if the property value goes down, you're not selling because you're a yield-oriented investor. You invest for yield, not appreciation. If appreciation comes, hey, icing on the cake, fantastic. But look at the projected yield here. It's just nothing short of awesome.